I have here an income statement of a public company along with their balance sheet for the years 24, 25, and a 3-year on the consolidated statements of income. So let's take a look at the gross profit margin of this company. Gross profit. The gross margin is the gross profit divided into the sales. Okay, so in this case, I have the gross profit has been identified on their income statements. Okay, so I'm looking at three years. Okay, 25, 24, and 23. Let's compare them. The gross profit. Okay, so right away I can see that this is in millions. So this would be 51 billion in sales in 2023, dropping down to 46 billion in 2025. Let's see what effect that had on their gross profit margin. So the gross profit percentage for 2025 is 42.7, 44.5. These are percentages, okay, and 43.5. So we can see it went up from 23 to 24. Seems like it's going in the right direction, and all of a sudden it takes a dive. So it has decreased by approximately 2%. Okay, let's see what it had on the profit margin. Okay, my profit margin is net income over sales. Okay, so my sales for these 3 years are going to be the same. And then I'm going to take my net income here, my net income, and see what percentage of sales that is. 3219, 5,700,000,000, excuse me, 5,070,000,000. So let's take a look at what those percentages are. What dropped to the bottom line? In 2023, 9.9%. Do the math, 11.1%. Get out your calculators and do these calculations along with me. Then what do you get for 2025? I get 6.95%. So it decreased by this is almost 4 by 4 percentage. Okay. So the gross margin decreased by 2%, the profit margin decreased by 4%. This is a company with some deterioration in sales, it looks like. Well, what else can we say about the profitability ratios? Let's take a look at how the relationship is with the balance sheet. So I have return on assets, which is going to be equal to net income divided into the average total assets. So my net income for this year was 3219, and average assets, we go to our balance sheet and we have 2 years comparison. So we add the 2 years together and divide by 2. So I add these 2 years together, 36,579, 36,579 plus 38,110. I get a product of 37,344.5. But before I use that, I double check just real quick I began with 38, then I was down to 36. Is 37 in the middle? Averages should be in the middle of the two numbers. Always double check that. Just a flash look, quickly look, did it match? Does it fit in the middle? Okay, so then go ahead with that number, and I get 8.6%. So the assets, the net income being produced is returning, the assets are productive, they're returning 8.6%. Return on equity is net income over average total equity. 3219 divided by my average total shareholders' equity. So once again, I add these two together and divide by 2, and I get 13,821.5. And yep, I double check, make sure it's halfway in between. Okay, and I got 23.3% return on equity. Return on sales. Okay, so return on sales, I take my gross profit margin minus my SG&A, and that gives me that operating income. And I look for sales net. So the gross profit minus the SG&A is going to be equal to net income before interest, expenses, and taxes, which is a really long word, and it's a subtotal that a lot of companies do put in called operating income. So in this case, okay, you can see those numbers right here, minus the SG&A over the sales. Okay, I get 7.9% return on sales. Profitability ratios for this company. We're wondering what happened with the sales. These are the profitability ratios for this particular company. If you want to know who this company is, Google who lost $28 billion worth of shareholder value in 2024. And you might come up with the name of this company. So yes, that 2% drop in gross profit margin, that 4% drop in profit margin, it shook the shareholders market, and the value of the stock reacted. This is Professor Campbell showing you the profitability of this company, the ratios, and how to use them.